It was kind of this list of basic investor protections that have existed in the traditional securities world for years, right? Things like you shouldn't be able to go unload all of your holdings right after the quote IPO, right? And there should be more disclosures and regular reporting. And I think I think these were all great ideas, but it did feel like perhaps the crypto world was just speed running the lessons of, 90 years of traditional finance. Hi, this is Matt Palker with Wendy Lee. We're co-founders at Ivy Invest, and welcome to this week's episode of The Investment Office. This week we're going to touch on a topic that elicits strong opinions from almost everyone, which is crypto.
Okay, so I have been super eager for us to touch on this topic because obviously I get to turn the tables a little bit around on you and ask you some of the questions as the subject matter expert on this. Why don't you share with everybody a little bit about your background in crypto and how you have been one of the early, I don't know if adopters is the right word, because I think you might say that you have a perspective that differs from many of the other folks who would be considered early adopters, but you certainly were an early explorer in this space. So
that's a nice euphemism. I have been referred to as an OG on occasion. Probably emphasis on the O. But yeah, I started what was probably the second venture-funded business in Bitcoin, actually, a company called 21, later became Earn.com, back in 2013. Coinbase had just raised their first, I think, $5 million a few months ahead of us. So it was certainly quite early. And like you said, I think I came to Bitcoin from a slightly different place than a lot of folks. I think a lot of the early interest in Bitcoin tended to be from people who had interest in often the economic aspects of it, sometimes the political aspects of it, or the intersection between the politics and the economics. My interest was actually technical. So prior to starting that company, my first company, Voltage Security, was an enterprise software company building cryptography software. So I had spent 10 plus years in the weeds on cryptography, and frankly, had actually been a little burned out just on the subject. Didn't expect I would go back into it. But all of a sudden, here was this really interesting new application of this technology I'd spent a long time working on, which was Bitcoin. And I just became fascinated in the ways in which encryption was being used, cryptography was being used, not to just secure data, but actually to create this new currency.
Okay, so going back in time to 2013, when you decided to start 21, what was your thought process? What was it that you were looking to solve or build for?
So what interested me in particular was this idea of Bitcoin as a new way to move value, right? I was actually in some ways less interested in the store of value use case, which we can talk more about, and I think which in many ways has become really the dominant use of Bitcoin outside of speculation and trading. But I was actually particularly interested. I had spent a number of years at Voltage, in addition to spending a lot of time obviously in security. We had a product that was focused on payments, and so moving money around primarily via credit card rails. And so I was actually just very interested in the application of Bitcoin as a way to facilitate the movement of money, both in that it could be more rapid, but also in particular that you could use it as a way to move much smaller amounts of money in an efficient way, right? If you look at your typical credit card transaction, there's often just a fixed fee, right? 29 cents plus 3%, let's say. And so, historically, there has been no great way to buy things for, say, a penny on the internet. And Bitcoin offered that promise, this idea of micropayments, that I was particularly fascinated in. But what I think is interesting is what we've seen, certainly over the last decade plus now, is that really never came to fruition.
Why do you think that is?
There's a lot of reasons for that. Part of it is there were some technical decisions that were made, in kind of the late teens that made the payments use cases more difficult to execute. But I also think that a large part of it has been that crypto, and here I'll talk more broadly, not just about Bitcoin, and I think Bitcoin has some unique aspects to it, but broadly crypto has moved from being predominantly about this interesting technology to just being this new asset class that people see an opportunity to make money in.
So on this payments question, especially as you look outside the US, I think there are probably more use cases where you see folks using their crypto wallets for payments. I don't know whether it goes down to the level of micropayments, but I'm curious if you see any of that as potentially fulfilling what you had originally thought could be one of the more interesting, again, use cases of what crypto could be.
Yeah, no, I think that's a great point, and I do think that it's not perhaps quite as revolutionary as what I had hoped would come to pass, which is this idea of a new way to buy things on the internet. But I do think that if you look today at the use cases of crypto beyond, again, speculation and just investing as an asset class, I do think that its ability to open up pockets of liquidity that exist outside of the financial system that you're sitting in. So if you're sitting in the U.S., right, the ability to open up pockets of liquidity that exist outside the U.S., where historically it may have been expensive or difficult to move capital from one jurisdiction into the U.S. or out. I do think that crypto has made that easier in some ways, and stablecoins have been, I think, a really interesting technology to enable that. But even there, I think the use of stablecoins has been primarily limited to use cases that are crypto on both sides, which is to say people wanting, for example, to access DeFi, these decentralized finance networks, these decentralized exchanges. That, I think, remains one of the big uses of stablecoins. I still don't think that we are seeing it used broadly for what folks refer to as TradFi use cases, traditional finance use cases, where people are, at least at scale, using crypto or stablecoins to access or make transactions within those systems. And I think that could come to pass, but I also think that a big challenge you have remains the usability of these systems and the relative opaqueness to the average consumer.
So I want to dive into this for a second here. You have seen this starting back in 2013. You've watched the evolution, the way that Bitcoin has been adopted, the evolution of the crypto markets, obviously the mania of, let's call it, the COVID 2020 era, where anything that remotely touched crypto or DeFi or Web3 blew up in lots of attention and capital raising. Why do you think, to your point about this opaqueness, and I want to hear your perspective on what that means, where the challenges remain, why some of the things that you thought could potentially come to pass, where this could, again, be a step forward for consumers, whether it's for internet purchases or anything else, why that hasn't come to pass. And you talked about, right, some of the challenges for consumers, but maybe expand on that a little bit more here.
Well, maybe I'll first touch on the opaqueness and the usability aspects, which I think are significant here. And I think that part of that is there's a natural tension here between what will make a system easy to use and familiar to the average consumer, and the core tenets of crypto, one of which is this idea of decentralization and not having to trust central authorities, right? And I think you see this in a very simple example is, where do you store your crypto? And the easiest place to store your crypto is going to be with a centralized wallet provider like a Coinbase or a Gemini, right? And they frankly will probably do a much better job than the average person of keeping your money secure, of auditing it, of helping you move it when you need to. But that centralization really kind of runs counter to the core ethos of crypto, which is traditionally this idea you should own your keys and you should not delegate ownership to some corporate third party. And you don't want all of your transactions traceable by anyone. And so I think there's that tension there. And I can speak to this just from a personal anecdote. I had some Bitcoin that I found on a very old, circa 2013 laptop. And I thought, probably shouldn't be on this old laptop. Should probably move it somewhere that's a little more accessible and a little more modern. And it was tough, right? This is somebody who has a lot of familiarity with the underlying technology and cryptography and security and knows what they're doing. But just the process of doing that, of finding software that you could trust, that would run on this old laptop, that could create the transactions that you needed to move it off, it was a pain. It was a multi-day process. And the average consumer could never go through that.
And so, if I'm hearing correctly, because this is also, as somebody who is I'll admit it, a non-user of crypto and Bitcoin, more just in part because early days it did seem like there were various levels of complication that you as an individual had to be more savvy about. So for instance, I think today I could, if I were so inclined, open a Coinbase account, open a Gemini wallet. But I think initially it was very daunting to me to think about remembering a key that, heaven forbid, if you forgot what it was, all of a sudden you just lose access to your assets. And that to me always struck me as a high risk to simply be off the grid. And so to your point about usability, and while I like the anonymity and the privacy aspect of it, it just seems really challenging to solve something that, for the average person, I don't think we need to be so off the grid.
Well, and I think that's honestly, right, that's the conclusion the industry has kind of come to, right? Which is the vast majority of people at this stage are not, I don't think, I have no data on this, but I don't think the average person is storing their crypto in some offline cold wallet. And most people are probably storing their crypto on Coinbase or Robinhood or Gemini or what have you. And that's great. I think in terms of, it's probably a much better outcome for those folks. But at the end of the day, you have to ask, well, how different is that than having a bank account at Chase or Wells Fargo or Citi, right? Yeah. Yes, technically, you could go to your Coinbase account at some point in the future and choose to move that crypto into some offline wallet that you control. But you could also go to Citi and go to a bank and ask for your money in $100 bills, and they'll give it to you, and you can put it under your pillow. And I'm not trying to equate these two things, but I do think that it all begs the question of what has been achieved here. And when I think back to the early days and the excitement and the vision people had for this kind of new world, I think that perhaps at best we can say it's been watered down.
Yes, and I think maybe to the other point around where we do see a lot of enthusiasm around Bitcoin and other cryptocurrency is around the store of value question. Whether that was something that was ever appealing to you, ever made sense to you. Again, given that you came into this whole space from a very different angle, and whether today you have a perspective on the use cases that have become so much more prevalent for both Bitcoin and other cryptocurrencies.
Certainly one of the early philosophical underpinnings of Bitcoin was this idea, like we've talked about, that a user could control their own keys, control their own, essentially, money, and not be subject either to the banking system, and do you trust, fractional reserve system, do you trust that your money is actually there? And then also not be subject to the whims, as I think some folks would say, of a central banking system, where you don't have, like in Bitcoin, a finite amount of currency. And I think that appealed to a lot of the very early folks in Bitcoin who, as I said, I think approached this from almost a philosophical perspective. That never spoke to me in the early days. I never personally perceived that I had a lot of risk having a bank account at a major FDIC-insured bank in the U.S. And while I think there are probably many arguments why our current reserve currency systems are not perfect, I think we have seen more stability in our economy over the last many decades than in history. And so I think there are, I certainly did not necessarily subscribe to that philosophical perspective. But I also recognized that there are lots of people, the majority of the world, the vast majority of the world, does not live in the U.S., and there are many people in the world who do live in places that have experienced rampant hyperinflation, where banks failed all the time and they didn't have the security of an FDIC. And so, from my perspective, I actually always thought that some of the most interesting use cases for Bitcoin were outside the U.S., in more emerging markets, where the trust in the financial system was probably lower for the average consumer. And I think that probably remains a driver for some amount of the adoption here. But, how much Bitcoin is being held by people in emerging markets relative to how much is being held in the US and Europe, I think it's probably a small fraction.
Okay, so from your perspective, again, having seen this from the beginning, what do you think is behind a lot of the drivers that you have seen in terms of the interest in cryptocurrency? And I'm happy to share my perspective, but I want to hear yours.
Yes, I definitely want to hear yours as well. And let me preface this all by saying I have never taken a position on Bitcoin price. I think it is unknowable why Bitcoin moves in the way it does, or any crypto, frankly. But there's clearly, if you just look at the supply-demand aspects of it, right? The demand has rapidly risen over the last decade. Back when I started, I think, Bitcoin was $70. Now we're, I think, as of today, north of 110,000. So that just speaks, obviously, to how demand has changed. And perhaps I'm a little cynical here. I think the driver of demand is the perception of more future demand, which is to say, I think that the vast majority of people who are buying Bitcoin today are buying it because they're speculating. They believe that the price will increase in the future. And certainly, if you look at annualized returns of Bitcoin over the last decade, it's remarkable, right? I mean, it is, people always say, oh, it's one of the best performing assets of all time. And that's probably true. But in a funny way, right, I think that cuts against the store of value argument, right? I mean, what makes a good store of value? What makes a good store of value fundamentally is that the purchasing power of your money will stay relatively constant, right? Like that's what you want in a store of value is fundamentally, if I have $100 today, or I can buy $100 worth of goods today, and I put it under my pillow, my metaphorical pillow here, that in 5 years I can still buy $100 worth of goods, right? That is a good store of value. If you've got an asset like Bitcoin that has been as volatile as Bitcoin has, and it's kind of by definition been volatile because if you just look at the rapid increase in price, that doesn't seem like a great store of value to me. Sounds like a good investment, perhaps, if you got in at the right time and get out at the right time. And that's just speaking to Bitcoin, where I do think that there are at least some decent arguments for utility. I think we've certainly seen beyond that lots of examples, whether you looked at, the ICO craze, the early DeFi days, lots of coins and tokens that were created out of nothingness and in some sense had no value other than the perceived value that there'd be more value in the future. And I think that's problematic. Okay, so now I want to turn the tables back to you, Wendy, and get, as an institutional investor, your perspective on this whole crypto thing.
Yeah, I think as institutional investors, there's increasingly a willingness to evaluate cryptocurrency and blockchain technology and the types of investments that fall under the Web3 ecosystem. There's an increasing willingness to evaluate them for portfolios. And I think we have seen some institutions in recent years move to actually include perhaps a portion of their assets in Bitcoin or Ethereum, which are the primary cryptocurrencies, where it's always been a little bit more challenging as an institutional investor, and where even today I find it to be challenging, is to really feel that, to your point, Bitcoin being a store of value, being an investment versus something that is more speculative in nature, even as of 2020, 2021, 2022, 3 to 5 years ago, a lot of the conversations around crypto for institutional investors, at least, were predominantly around whether or not it would be something that was investable. And there were a lot of conversations around blockchain technology as potentially being more investable. And that was really where I think there were a number of institutional investors, including the institutions that I was previously at, where we spent a lot of time actually, with various venture firms who were either exclusively focused on blockchain or who had blockchain as part of their mandate. And some institutions invested and others didn't. And I think where you saw a lot of institutions focus their time was really treating the possibility of investing in this space as sort of venture-like outcomes and returns, where it was worth allocating some dollars to, in the event that this technology really did completely transform financial services, in the event that it did completely transform what payments might look like. And I think today, where we've seen the institutional adoption is still pretty varied. I think there are more institutions, as I mentioned, that are willing to consider having some amount, and when I say some amount, like really, truly, typically it would be very small amounts in direct cryptocurrency holdings like Bitcoin in particular. But where I think it's been most surprising is, if you had asked me 5 years ago, I really would have thought that the blockchain technology and the potential use cases and the ways that it might be adopted in creating, instantaneous transactions and having things be on a ledger and be potentially more transparent and traceable, and expecting there to be sort of more utility and utilization of that in financial services. I don't know that that has been the case, and I am more surprised. And if I had to, again, step back 5 years ago to say where might we find ourselves, I would have said I really would have expected to see greater adoption of the technology and thinking that the technology would be more widespread. I don't think I would have expected that it is, in fact, just, to your point, it's the cryptocurrencies themselves, the Bitcoin, the Ethereums, and some of the other coins that have been, whether bid up for a meme purposes or bid up because folks genuinely see them as stores of value. I don't know that I would have thought that this would be the outcome, 5 years ago to today, that the greatest value accretion in crypto and blockchain has actually been in these cryptocurrencies. And so, I reflect on that, and I think that to me is surprising. And there's a part of me that does still, maybe you feel the same way, where I think the underlying technology, right, the potential use cases for blockchain technology are, I think, still out there. But I think there was much greater expectation that it could really revolutionize how financial services work. And maybe we're just still early innings in that, but I would have thought that we would have seen more of the value creation there versus purely in the run-up in cryptocurrencies themselves.
Yeah, and to your point, I think at this point, the folks who say we're in the early innings of crypto, I think they have to be honest with themselves that we're probably in the fourth or fifth inning at this point. We may not be at the stretch yet, but we're getting close. And so I do think that folks who, for many years, were promoting the idea that this was going to revolutionize how we do financial services, I think they have to be honest with themselves that that may not come. And I do think that part of the challenge that has made it harder for that to come to fruition is that there was too much liquidity for early creators in these spaces, right? A company would be founded with a big vision. They would issue some kind of coin or token that was going to fuel the underlying technology and funding of the underlying technology, that coin would ramp up in value. And then often there was very little holding the founders or the early investors back from unloading and selling those positions. And I think it resulted in particularly some of those early crypto venture funds demonstrating remarkable returns. But I don't think it actually served the purpose of generating long-term value well. And I thought it was interesting. I saw a post from somebody in my network who I think is a smart crypto investor recently on LinkedIn. And he was proposing a number of things that he thought should be in place to try to protect against this dynamic and help projects actually create more value. And it was just, to me, it was a funny list because it was kind of this list of basic investor protections that have existed in the traditional securities world for years, right? Things like you shouldn't be able to go unload all of your holdings right after the quote IPO, right? And there should be more disclosures and regular reporting. And like I think these were all great ideas, but it did feel like perhaps the crypto world was just speed running the lessons of 90 years of traditional finance.
Yes, I think that is a funny observation. It's one that one of my favorite columnists at Bloomberg, Matt Levine, remarks upon all the time when he happens to write about a particular crypto story or other. He often remarks that it's like the folks that are in this space are rediscovering all the lessons that traditional finance has learned over the past 100 years in rapid time. But it is, I think this is one of those things where when I think about, again, putting on my institutional investor hat, when I think about what is investable and what is potentially more of a speculative perspective, I think it's really challenging with something like the cryptocurrencies themselves to really determine what is the right fundamental value for any one of these. I think that's the challenge when it comes to things like gold or Bitcoin, which are treated as stores of value, but which also tend to see speculative runs. And Bitcoin in particular, I think of as being slightly different than gold, because I think gold at times, and this is where investors, again, this is me putting forth what I have seen in the experience of investors more broadly, not necessarily personally held opinion here, but for investors who have used gold as a store of value, who have seen it as a store of safety, where that has been reflected in markets, and the market price of gold is oftentimes in periods of volatility. You'll see gold be non-correlated, or you'll see gold rise where there are periods of greater stock market volatility or concerns about the value of the dollar. And so in that sense, for better or for worse, and I won't necessarily put out a strong opinion in either direction, other than to say that historically gold has been utilized in this way, and utilized pretty consistently in this way. So it's, if nothing else, has decades of history being utilized in this way, if not centuries of history being utilized in this way. Bitcoin is newer as having this tag of store value, and I think Bitcoin has, to your point, exhibited an extraordinary amount of volatility, and in many ways has behaved much more like a risk asset, where when it's risk on and risk appetites are high, you tend to see Bitcoin and other cryptocurrencies also generate a lot of higher returns. And then when risk appetites lower, when markets become more risk off, you have seen historically also that cryptocurrency prices are turning down as well. And so in that sense, it really has not, I think, borne out as much the promise of store value, flight to safety type asset. That aside, I think it is hard to ignore what's happened and what continues to happen in and around Bitcoin in particular. And so, you've been in this longer than most, and And I don't know if you have any closing thoughts you want to leave folks with, but I think to me it's just been really fascinating, if not always fundamentally understandable to me.
I think that's a good way to put it. And I guess what I would close with is I think most people probably over the last several years would have described me as a crypto bear. And I think certainly as you look at the price, I have been consistently proven wrong. And all of that is to say, I don't think anybody really knows much of anything when it comes to crypto. And the future is certainly yet to be written here. But I think it is safe to say at this point, I do think Bitcoin will be with us for a long time. I do think that absent some significant security flaw, which I think is very unlikely at this point in Bitcoin, given how many folks have been staring at this for a long time, I do think the likelihood of Bitcoin going to zero anytime soon strikes me, it is getting lower and lower, that probability. And so I do think it'll be something that we'll probably be talking about still, whether the price has continued to skyrocket or come back down to earth. I think it is something we'll probably be still talking about in 5 to 10 years. Well, that was enough crypto for one day. Thanks for joining us on this week's episode of The Investment Office. We'll see you next week.